Amazon, Meta, Microsoft, Wall Street's $255 billion AI bet. Explain why Wall Street has already poured more than $255 billion into AI hyperscalers in 2026, what that says about the data center race, and what operators and investors should watch before treating the build-out as an automatic winner. The most important AI chart this week is not a model benchmark. It is a funding number. Wall Street has already handed Alphabet, Amazon, Meta, Microsoft, and Oracle $255.34 billion in debt and equity in 2026. That is more than twice what those same companies raised in all of 2025. In plain English, AI is becoming a capital markets story as much as a technology story. Axios reported these 5 companies say they expect to spend roughly $750 billion on AI data centers by year-end. That means this is not idle capital sitting around for optionality. The money is being raised to build, lease, and wire enough compute capacity to support the next phase of AI demand. The market is underwriting a physical build-out, not only a software narrative. The skeptical question is whether all of this is still normal corporate finance. Anthropic gives us the clearest reason the answer is no. Axios reported Apollo and Blackstone partnered with Broadcom on a platform backed by an initial $35 billion loan that will help Anthropic lease Google chips housed in fluid-stack data centers. That starts to look less like a routine vendor purchase and more like infrastructure finance wrapped around compute access. Axios reported PitchBook said the hardware is being held in a special purpose vehicle so it stays off Anthropic's balance sheet. That matters because it lowers visible debt pressure for a company preparing for a possible listing. But it also matters because regulators tend to pay closer attention when fast-growing sectors start using structures that make leverage easier to carry and harder to compare. There is a real debate here. One side says AI demand is so large that compute has to be financed aggressively, just like telecom, rail, or power infrastructure once was. The other side says the market may be front-loading years of spending before the revenue curve is fully proven. Axios explicitly noted concerns about an AI bubble and questions about whether the investments will pay off. Both readings can be true at the same time for a while. If you run a company, build on AI, or follow the sector, watch 4 things next. First, how quickly raised capital turns into real usable capacity. Second, whether enterprise demand and software revenue actually absorb that capacity. Third, where financing sits on or off the balance sheet. And fourth, whether regulators start pushing for tighter disclosure on AI infrastructure vehicles. Those signals matter more now than the next flashy product demo. Not included. My judgment is that the AI race has moved into a new phase where financing structure matters almost as much as product capability. The winners may not simply be the labs with the smartest models. They may be the companies that can fund, structure, and deploy enough compute without blowing up margins or trust. So here is the question: if AI value keeps moving into infrastructure and financing structures, which signal matters most now, revenue, utilization, or the cost of capital? Create a polished explainer video in explainer format using classic style. Keep the narration calm, chart-driven, and source-backed. Use two-host energy if supported, a lead narrator plus a skeptical analyst who keeps asking whether this capital flood represents durable infrastructure demand or speculative overbuild. Change visuals every 3 to 5 seconds using source cards, funding charts, server hall panels, financing stack diagrams, and operator watch list cards. Do not use fake footage of a real trading floor event, investor meeting, IPO filing, or data center ribbon cutting as if it were evidence. 1 June 10, 2026 to $255.34 billion 3. $108.44 billion 4. More than 2x 2025 5. 5 hyperscalers 6. Alphabet 7. Amazon 8. Meta 9. Microsoft 10. Oracle 11. About $750 billion expected capex by year-end 12. $35 billion initial loan 13. More than 20 gigawatts through 2028 14. Fluid stack data centers 15. Off-balance sheet SPV structure 1. One-page summary 2. Links mentioned 3. Key terms explained 4. Practical examples 5. Watch list and risks not financial advice. Educational analysis only. #AI #data centers #big tech #AI stocks.